What if I told you that while Wall Street is bleeding, tech stocks are collapsing and investors are panicking? One mining stock just smashed its all-time high. No hype, no meme stock frenzy, no Reddit army. Just pure money flow, driven by fear, geopolitics, and the oldest safe haven assets in human history, gold and silver. As headlines scream about trade wars, tariffs, and global conflict, while President Donald Trump threatens 8 nations over Greenland. Capital is quietly fleeing risk assets and rushing somewhere else. And right in the middle of this storm stands Hudbay Minerals, a company most retail investors ignored for years, a stock Wall Street barely talked about. Now suddenly, up nearly 10% in a single day, hitting an all-time high while markets crumble. Gold near $4,700 an ounce. Silver flirting with $95. Copper quietly breaking out. Is this just a temporary spike, or are we witnessing the early stages of a historic commodities supercycle? And more importantly, is Hudbay Minerals still a buy at these levels, or is the smart money already preparing its exit? Stay with me, because by the end of this video, you'll understand why this rally is happening, what comes next, and where the real money may flow next. Why Hudbay Minerals, HBM, just exploded while Wall Street bleeds. While most of Wall Street was drowning in red, one stock quietly did the unthinkable. Hudbay Minerals Inc., ticker symbol, HBM, surged nearly 10% in a single day and printed a brand new all-time high. No earnings release, no surprise acquisition, no viral hype, just pure macro forces colliding at the perfect moment. On Tuesday, Hudbay Minerals hit an intraday high of $24.74 before closing just a few cents lower at $24.69, locking in a 9.73% daily gain, an extraordinary move for a large cap mining stock. To understand why this happened, you need to zoom out, far beyond Hudbay itself. Fear is back in the market, and money is running. Markets don't move on logic alone. They move on emotion. And right now, the dominant emotion is fear. Fear of escalating geopolitical tensions, trade wars returning, tariffs disrupting global supply chains, inflation refusing to die, currencies losing purchasing power. Over the weekend, President Donald Trump reignited global tensions by threatening to impose new tariffs on 8 countries that oppose U.S. ambitions related to Greenland. The single development sent a clear message to markets. Global cooperation is weakening. Economic nationalism is back. And whenever this happens, investors instinctively do one thing. They abandon risk assets and rush into hard, real, tangible value. Gold and silver are screaming danger. The strongest signal didn't come from stocks. It came from metals. Gold surged to nearly $4,700 per ounce. Silver exploded to around $95 per ounce, an all-time high. These are not normal moves. Gold and silver don't surge like this unless something is deeply wrong beneath the surface. They rise when trust in governments erodes, paper, currencies, weakened debt levels become unsustainable, war and trade conflict loom. This is money seeking safety, not speculation. And Hudbay Minerals sits directly in the blast zone of this capital rotation. Copper confirms this is not just fear, it's a cycle. Here's what makes this moment especially powerful. This isn't just a gold and silver panic rally. Copper is rising too. Benchmark copper prices climbed to roughly $12,965 per metric ton, up more than 1.2%, signaling something critical. This is not just fear. This is real demand. Copper is the backbone of electrification, EVs, AI data centers, renewable energy, infrastructure spending. When copper rises alongside gold and silver, it suggests a structural shift, not a short-term trade. And Hudbay Minerals is one of the few companies that benefits from all 3 metals at once. Why Hudbay is perfectly positioned for this moment. Hudbay is not a one-metal story. It is a diversified mining powerhouse, producing copper, gold, silver, zinc, molybdenum. That diversification is exactly why institutional money is flowing in. When investors don't know which metal will lead next, they buy companies exposed to all of them. Hudbay offers leverage to rising prices, scale and liquidity, exposure to both safe haven and industrial metals. In simple terms, Hudbay wins whether fear rises or growth accelerates. That is a rare setup. This move was not retail. It was smart money. A near 10% move in a mining stock of this size does not come from retail traders. This was institutional capital rotating. Funds that were overweight, overvalued tech, weak bonds, currency-exposed assets are now repositioning into hard assets, real production, tangible cash flow. Hudbay Minerals became a primary beneficiary of that rotation, and this may only be the opening act. The real numbers behind Hudbay Minerals: production, earnings, and what Wall Street is pricing. In part 1, we talked about why Hudbay Minerals exploded, fear, geopolitics, and a massive rotation into hard assets. But now comes the most important question. Is this rally built on real fundamentals or just market emotion? Because in the long run, numbers always win. And when you look under the hood at Hudbay Minerals, the numbers start to explain why institutions are stepping in now, not later. Hudbay is not a story, it's a production machine. Unlike many mining stocks that trade on future promises, Hudbay is already producing real metal at scale every single day. For full year 2025, Hudbay reported strong preliminary production results. Copper, 118,188 tons. Gold, 267,134 ounces. Silver, 3.47 million ounces. Zinc, 17,646 tons. Molybdenum, 1,282 tons. These are not speculative assets sitting in the ground. This is confirmed output at a time when global supply of metals is tightening and new discoveries are becoming harder and more expensive. Every ounce produced today becomes dramatically more valuable when prices surge, and that is exactly what's happening now. Q4 2025, the quarter that changed everything. The strongest signal didn't come from the full year. It came from Q4 2025. Hudbay's fourth quarter production numbers showed momentum accelerating, not slowing. Copper, 3,369 tons. Gold, 84,298 ounces. Silver, 1,000 million ounces. Zinc, 5,703 tons. Molybdenum, 325 tons. Why does Q4 matter so much? Because Q4 production feeds directly into year-end cash flow, balance sheet strength, dividend, and reinvestment decisions, forward guidance. Strong Q4 results often signal even stronger years ahead, especially when commodity prices rise after the quarter ends. Metal prices are doing the heavy lift now. Here's the key insight most investors miss. Hudbay produced much of its 2025 metal at lower price assumptions. Now those same metals are trading at gold near $4,700 Aussie, silver around $95 Oz, copper close to $13,000 ton. That creates operating leverage. A $100 move in gold doesn't just add revenue, it expands margins. A $1 move in silver doesn't just boost sales, it multiplies free cash flow. This is why mining stocks often move after the metals move, and then move much faster. February 20th, 2026. The next major catalyst. Hudbay Minerals is scheduled to report full year 2025 earnings. Q4 2025 earnings on February 20th, 2026. This is not a routine event. It's a market-defining catalyst. Why? Because investors will finally see how much cash Hudbay generated, how margins expanded, what management expects for 2026, how capital will be allocated. Markets don't wait for earnings. They anticipate them. The recent rally strongly suggests that expectations are rising. Why institutional money is comfortable buying here. Big funds don't chase momentum blindly. They buy when three conditions align. 1, strong macro tailwinds. 2, verified production. And scale 3, clear upcoming catalysts. Hudbay checks all three boxes. Additionally, it offers liquidity for large positions. It provides diversification across multiple metals. It acts as both a growth asset and a hedge. In an uncertain world, that combination is incredibly attractive. What this rally is and what it is not. Let's be clear, this rally is not a meme stock surge, a retail frenzy, a one-day headline reaction. This is capital rotation, risk management by institutions. A repricing of real assets that doesn't mean Hudbay will move straight up. Pullbacks will happen. Volatility is guaranteed, but the foundation of this move is solid. Is Hudbay Minerals still a buy after an all-time high, or is smart money rotating? Now we reach the most important question of this entire series. After surging to an all-time high, is Hudbay Minerals still worth buying, or has the smart money already made its move, leaving late investors holding the bag? The answer isn't emotional, it's strategic, and it depends on what kind of investor you are. The bull case. Why Hudbay's run may be far from over. Let's start with the upside. Hudbay is operating in the most supportive environment miners have seen in decades. 1, a commodity. Supercycle is back on the table. The world is entering a phase defined by deglobalization, trade wars and tariffs, onshoring and reshoring, military spending, energy transition, infrastructure, rebuilding. All of these trends require massive amounts of copper. At the same time, geopolitical stress pushes investors toward gold and silver. Hudbay sits at the intersection of growth metals and fear metals, a rare advantage. 2, rising prices or exploding cash flow. Mining stocks don't move linearly, they move with operating leverage. A 10-15% rise in metal prices can translate into 30-50% increases in free cash flow, rapid debt reduction, higher dividends or buybacks, stronger balance sheets. If gold stays near $4,700, silver near $95, and copper above $12,000, Hudbay's earnings power could reset much higher. The market is beginning to price that in, but it may not be finished yet. 3. Institutions still need real asset exposure. Most large funds are still underweight commodities. They are overweight. Tech bonds, paper assets. As inflation and geopolitical risk persist, portfolio managers are being forced to rebalance. Hudbay offers liquidity, multi-metal exposure, proven production, inflation protection that makes it an easy institutional choice. The risk side, what could go wrong from here? No honest analysis is complete without risk. 1. All-time highs. Attract profit-taking. When stocks hit record levels, early buyers take profits. This can lead to short-term pullbacks, volatility spikes, shaking out weak hands. A 15-25% correction would not break the trend. It would be normal. Chasing green candles is how retail investors get hurt. 2. Metal prices. Our volatile commodities move fast, both up and down. Any of the following could pressure prices. A sudden de-escalation in geopolitics, central bank intervention. Unexpected recession fears, dollar strength. Hudbay's stock will always follow metal prices first, fundamentals second. 3. Mining is capital intensive. Mining comes with high operating costs, political and regulatory risk projecting, delays, cost overruns. These risks never disappear, even in bull markets. The smart strategy, how professionals are playing. HBM smart investors are not asking, should I buy or sell? They're asking, how do I size and time this correctly? Common institutional strategies include buying partial positions on pullbacks, holding Hudbay as a hedge, not a core growth bet, pairing miners with non-correlated assets, rotating profits into other high upside sectors. Hudbay is often used as portfolio insurance, not a YOLO trade. Why some capital is quietly rotating into AI and onshoring stocks. Here's the key insight most people miss. While miners benefit from fear, AI and onshoring stocks benefit from policy. Trump-era tariffs and trade policies are accelerating domestic manufacturing, automation, defense technology, AI-driven logistics and supply chains. Some AI stocks are extremely cheap profitable, benefiting directly from tariffs, shielded from global supply disruptions. That's why some funds are holding Hudbay for protection, while deploying growth capital into AI and reshoring plays. This dual strategy reduces downside risk while preserving upside. Final verdict, what Hudbay really represents. Hudbay Minerals is not just a stock, it's a signal that the world is moving away from paper promises. Real assets are regaining value. Geopolitics is driving markets again. Commodities are no longer ignored. Hudbay may pull back, it may consolidate, it may even correct sharply, but the reason it moved hasn't disappeared. Final message to viewers. High retention close. If you're watching this and wondering whether it's too late, ask yourself this instead. Are we closer to global stability or further from it? Because as long as uncertainty dominates, hard assets will remain in demand. Hudbay Minerals is one of the cleanest expressions of that reality. The question isn't whether volatility is coming. The question is, are you positioned for it or exposed to it?